Hello and welcome. Thank you for joining us on Business Incorporated live from Lagos, Nigeria. I'm Chimizie Obi Iwawo. IMF releases its statement on Mozambique after a visit to the southern African country to reassess recent economic developments there. The Nigerian Ports Authority reports increase in revenue owing to series of reforms. Plus, football club AC Milan sold to a Chinese consortium. We'll begin with markets. The pound has hit a fresh 31-year low against the dollar as worries over the UK's exit from the European Union continued to rattle financial markets. Sterling dropped to $1.27 at one point in Asian trade before recovering slightly to $1.29. Now, the pound has now fallen by about 14% against the dollar since hitting $1.50 ahead of the referendum result. The Asian stock markets had closed lower, with Japan's Nikkei index down 1.9%. Government bond yields have also fallen to record lows as investors rush to put money in perceived havens. Now let's cross over to Frankfurt Stock Exchange to see what's happening to the stocks there and, of course, the euro. DWTV Channels TV financial correspondent Conrad Bosen joins me now. Good afternoon, Conrad. While the pound sterling fell to a new 30-year low, which also means the UK is not the world's fifth largest economy anymore, what triggered the renewed slump?
Well, the mere fact that if you calculate it in euros, the British economy has stopped to be the fifth largest economy. It's been overtaken by France, is something which is negative for the currency of the United Kingdom. But of course, the trigger for that renewed slump was something else. In the United Kingdom, three financial commercial property funds have stopped investors to pull out of money out of their funds, and that means that quite obviously that's an indicator how much investors in those property funds and in other British assets have drawn their money out of the United Kingdom after the Brexit referendum. What's more, the chief of the Bank of England, Mark Carney, yesterday made it quite obvious and quite clear that the Bank of England is ready to continue to print money, which means that on the markets people are getting prepared for further interest rate cuts in the United Kingdom. And if you cut interest rates, if we talk about lower interest rates, of course that has a depreciating effect on the currency, because this currency, the British pound in this case, becomes less attractive for investors.
Now, investors are beginning to seek safe haven investments like government bonds, which is sending bond yields lower again. The yield on American treasuries has hit a record low overnight. Are the Brexit, related concerns the only reason behind this?
The concerns are that what's happening in the United Kingdom might not be limited to the United Kingdom, that it has caused so much uncertainty that at least Europe-wide we're going to see less investment, less economic activity. Take Sweden, for example, the Riksbanken there, which is the Reserve Bank of Sweden. It had kept its key lending rate in negative territory for a while already at minus 0.5%. Traders, analysts, people on the financial markets for a while now had been talking about when and how much the Swedish Riksbank would return its negative interest rates up towards the positive level again. But today, the Reserve Bank in Stockholm announced that it will postpone any interest rate hikes it had planned until now, because it is concerned about the potential negative impact of Brexit on the Swedish economy. Now, if we are talking about negative interest rates, also here in Germany, the yield on the German Bunds, which are the 10-year government bonds, the benchmark, if you like, it already was in negative territory since a couple of weeks. It's now sank further down into negative territory to another record low of minus 0.2% today.
Now we've seen shares of the European banking sector suffering, with Deutsche Bank's share price temporarily hitting a new record low. Are investors concerned that a new financial crisis might occur?
People here are discussing this topic, definitely. Analysts and traders, economists are concerned, and they ask this question as well. I've been also told that the overall situation of the banks in Europe after the last financial crisis, which happened after the Lehman Brothers collapse, the overall situation in terms of how much capital buffers they have is much better than it was during the last crisis. But mind you, the concerns are there. If we take Italy, for example, the banks there are sitting on a large amount of bad debt, of bad loans, loans which are considered not to be paid back. And that has a very negative effect on the capital basis of those banks, so that now people here are speculating that soon we might see the rules of the European Banking Union applied. Those rules were introduced after the last financial crisis, and they deal with what happens to a bank when it threatens to be insolvent, or when the capital basis is so low that the regulation has to say you have to do something. The fact that people are discussing about those rules to be applied eventually means that they are afraid of other financial crisis.
Well, thank you very much for your time, Conrad. Do have a wonderful day. Now, in the U.S., investors have continued to put money into the markets despite the volatility in June. Our Jill Maladrino, VOA Channel's TV business correspondent in New York, meets with the chief market strategist of TD Ameritrade, Joe Kinahan, to discuss what stocks are not and where traders are placing their bets.
Investor Movement Index is a proprietary index by TD Ameritrade that aggregates retail investor trades, like myself and like you, JJ, to give us a clue as to what retail investors are looking at in the market. Let's talk about trends in June, because it was quite a volatile month.
Yes, it was. And it's very interesting, Jill. We've seen over the last couple of months our clients become more engaged with the market, but in June it really topped out. And so, as you said, it's a proprietary model. It came in at 5.00. That doesn't really mean anything to anybody, except to put it back to what it really does mean, is that our clients were much more engaged with the market than they've been the past few months. They used the whole Brexit situation as an opportunity to become more involved with the market rather than less involved with the market.
That's really interesting, because a lot of people question themselves, should I sell out of my 401k, my retirement account, going into, you can't market time. Even the professionals can't market time. In fact, we're flat on the year, essentially, so it was a good thing if you stayed involved in the market. What were TD Ameritrade clients buying?
Well, so the FANG stocks, as you would kind of imagine. Facebook is always a favorite of our retail clients. It's usually in the top 5 traded stocks almost every day. And so, not surprising, with a little bit of a dip, people came in to buy Facebook. They also bought Amazon. Again, another somewhat favorite of the retail client. So those two. What was interesting to me is they bought Ford and GM. Now, Ford and GM did not have a great month, but what it is that we see what's going on with the bond market right now. We see that interest rates are, I'll use the word fairly non-existent in most of the world and very low in the U.S. And Ford and GM pay a yield near 5%. So I think the thought process among our retail clients really is, I want to get yield, but I want to do it in a name that I trust, more of a blue chip type name. That being Ford and GM.
Is that why we saw utilities and telecom outperform other areas in the market?
Absolutely, because again, people are searching for yield. It may not be for their whole portfolio, but they need to get some yield somewhere in their portfolio, especially as we have an aging population. The baby boomers in the U.S. coming near retirement need to get some return on that money as they come into retirement.
Now that we're beyond Brexit, do you think that's good for the U.S. markets? Because global investors have to put their money somewhere, and we seem to be a little bit more stable than Europe and the emerging market areas?
I think it's good for the U.S. Interest rate market in the fact that if you're long bonds, it's been very good. We've had a big fear that there's going to be a bond crush, so to speak. That's quite the opposite of what's happened, and I think, you and I have talked many times. I think a year ago, nobody would have suspected, we thought we'd be talking on a 10-year rate, 2.5, maybe even 3%, not under 1.4. So that's the big shock. The problem is going to be, we're coming into an earnings season, and it's going to be very difficult for the CEOs to say what's going to happen, even though the analysts are going to want to know.
Well, that was the chief market strategist at TD Ameritrade, Joe Kinahan, discussing on the markets with VOA Channels TV business correspondent Jill Maladrino. We'll take a quick break, and when we come back, a focus on Mozambique's economy. To stay with us.